So today I'm going to introduce the covered call, and I'm going to compare it to a deep in the money covered call using an example. So first of all, the covered call is the first strategy that most investors use when they start trading options. It's a simple way to collect some extra money on stocks that you own. So again, as with any strategy, you need to pick a stock that you think is appropriate for this strategy. So in this case, we're going to look at a stock where we see limited downside risk, but at the same time, limited near-term upside. So we think the stock or the markets are going to trade in a range, not too much higher, but not too much lower. So we want to collect some extra money while we're holding the stock. So for our choice today, we have Crescent Point Energy on the TSX. So the reason we chose this stock is because it's paying a huge dividend here, over 10%. And this dividend has never been cut by the management, and they reassure that it will not be cut. The price of oil has hurt the stock price. So as you can see, the 52-week low got all the way down to 21.20 from a 52-week high of 47.46. So the stock price has come off significantly, but we still see this as a good buying opportunity because a lot of their production has been hedged at higher oil prices. So we think the dividend is safe, and we want to own this stock and collect that dividend while we wait for better times for the oil price to rise and for the stock to rise with it. So first thing we have to do is take a look at an options chain. So right now, Crescent Point's trading at around 25.50. So we're going to look at two different call options. We're going to own the stock, buy it at 25.50, and then we're going to sell call options against it at two different strike prices. So one is a deep in the money covered call. We'll look at $21. And the other one's an out of the money covered call, and we're going to look at $27. So first thing, we're going to go over the covered call example. So here we have our options calculator. Again, you can get access to this through our website. First thing we're going to look at is how much is it going to cost to buy the stock. So right now it's constantly updating, but we're trading at 25.54. And most of our trades, we look at amounts of about $10,000. So we're going to look at 400 shares. So 400 shares times $25 is 10,000. So we're a little more than that. And the expiry we're going to look at, going back here, we're going to look at January 20, 2017. So this is 18 months away. And the first strike price we're looking at is the $27 strike. So at this $27 strike, someone is willing to pay us, the bid is currently $2.24 per share, to get that stock from us if it rises above $27. So there are some people who don't want to outright buy the stock at $25.50. Maybe they don't have the money, maybe they don't want the downside risk. But if the stock skyrockets, goes back to $40, they want that upside. So they're willing to pay us right now $2.24 to get the stock if it goes above 27. Right now the ask is $2.94, so the people selling that option are willing to sell at $2.94. So generally, if you're doing this option, we try to play it in the middle, right down the middle. So for our purposes, we're going to look at $2.59 as a premium we can collect. So that's $2.59 on every share. So that would bring us in a revenue of over $1,000 on this option. Now, you have to remember with a covered call, though, we're losing that upside. So again, if we go back to our option chain, we're losing the upside of anything above $27 up until January 20th, 2017. So if the stock does go to $40, we have to sell it at 27. So you do not want to do this on a stock that you think is going to skyrocket. We've made mistakes in the past. We've done covered calls on stocks such as Netflix, for example, where we lost the stock at $60 because it had a huge jump and continued skyrocketing, and now the stock is, before its 7-to-1 split, is trading near $700. So, that would have been tenfold of our profit, but unfortunately we missed that because we sold the covered call. So you don't want to do this on stocks that you think are going to go much, much higher in the near term. But we don't think that with Crescent Point. We think it's going to stay in this range. And we're happy to sell at $27 while collecting the dividend for those 18 months. Why? Well, this $2.59 premium is 15.9% above our current price. So the time value, the value of the option, they're paying us 16% just to get that option to buy it at $27. So that's a significant premium here for us to collect and still at the same time be collecting the dividend. So the dividend's $2.76 annually. So over these 18 months, we would collect $1,656. So you add that to the premium we're getting of the $2.59 per share, and at our $27 strike price, we would make a profit of $3,263.01 after all of our fees. And again, everyone's fees are different. We're going to do a little video of that after if you want to compare different brokerages. But we get very low fees with who we use. So for us, the profit will be $3,251.01, which would amount to an annualized return of 23.55%. So we only have to put down a little over $9,000 and 400 times our stock price of $25.56 minus the premium revenue we're collecting of a little over 1,000. So for a cost of $9,204.99, we can make a profit of $3,251 or about 23.5% over an annualized period. Now, all that has to happen for us to reach this profit is the stock goes up 5.63%. So if the stock goes up from $25.56 to $27 in the next 18 months, we're going to make $3,251 or 23.55% annually. Now, that's a fantastic return for a stock to only move 5.6% in 18 months. Also with this, we have some downside protection because we are collecting that premium. So we get that $2.59 no matter what. So even if the stock drops, our break even, instead of being $25.56, our break even cost now is $23.01, which is 10% below the current market price. So that means Crescent Point can drop 10% from its current price and we'd still break even. So this is why a covered call is a good strategy to use to hedge some of your risk, but it also limits some of the upside. So you want to do this on stocks that you think are going to trade sideways or that you can collect the dividend and you don't care about the capital gains. You're just happy collecting the dividend and a little bit of premium. Now in comparison, you can also do what we call an in the money or deep in the money covered call. Now this is a little different. We're going to look at the $21 strike price right here. So a $21 strike price implies that the stock is already trading well above this. So the likelihood is that this stock's going to get called away either on January 20th, 2017 or before then. Now, why would we want to do that? Why would we risk losing the stock? Well, this would be because maybe we don't care about, again, the capital gain, the upside. We just want the dividend and a small premium. But we want very, very limited risk. We're worried about the markets. We think the stock could still go down. We don't want it to go down and to lose money. We want it to be safe. So we're going to do a deep in the money covered call. So instead of selling at a $27 strike price, where the stock has to go up for us to make our maximum return, we're going to sell at a $21 strike price. So what this means is we don't care if Crescent Point trades anywhere in this range. Anywhere between 21 and above, we're going to make the same profit. So we could care less. So the stock would have to drop almost 18% to hit our strike price. So unless the stock drops more than 18%, we're going to give up our stock on January 20th, 2017 to whoever bought our option, or else we have to buy it back and close out our position. and that's our choice at the end of the period. The premium we're going to collect is higher, $5.60. So we're going to get a revenue of $2,230. That means our cost is only a little under $8,000 because again, 400 shares at $25, but we're collecting more than double the premium this time. So our cost is only $8,000. We're not getting as much premium over and above the stock price. So again, quick calculation here, 21 plus 560 is $26.60. So we're only getting $1 above what we're paying for the stock. We're not getting significant premium here, but we're getting a lot of downside protection. So what we're getting is the same dividends and a little bit extra premium. If the stock skyrockets, someone's still willing to pay $5.60 to buy it at $21. They're still willing to pay more than market price. So at the strike, so anywhere above $21, we would make a profit of $2,047.01, which amounts to an annualized return of 17%. Now, this is a great strategy to use to collect solid dividends. So a company that you believe is going to continue paying the dividends, which we do with Crescent Point, you can collect those dividends with almost no worry about what the stock price is doing. The only danger is if the stock price drops more than 18%, which we're not too worried about. If it did drop more than that, it would have to go further than its 52-week lows, go down below its 52-week lows. And at these levels, we would still be comfortable owning the stock. We would have a break even of $20.02. So if we can own Crescent Point at $20.02, we'd be happy. So that's $5.50 cheaper than what the market price is. So we have a lot of downside protection. So the stock has to drop about 22% before we're in a loss position. So we'd be very comfortable with that. So this is a strategy that people can use near retirement when they need that money in the near term. They don't want to have huge losses or a lot of risk in the markets, but of course you can't be putting it in GICs or treasuries or anything like that because the returns are just too small. Now, if you can get a 17% return, that's fairly safe. That's a great way to invest for people of all ages, and especially those who are a little bit more conservative. If you'd like to follow us, our Twitter is @DayTradeCanada, and we also have our website with investment information. We've got our picks, our news, upgrades, downgrades, and we've got all our archived information from the past. So please follow us for all the news you need about the markets, and feel free to contact us anytime. You can set up a meeting, join our subscriber list, and get access to all of our calculators and our spreadsheets. Have a great day and good luck in the markets. Bye-bye.